It looks to me to be in the same place, Mark.
Oh, you're so helpful.
All right.
All right. Well, good afternoon, everybody, and happy New Year. Welcome to the January 4th edition of Bull Sessions. My name is Mark Robertson, and I'm joined here by Ken Kavula. He's the one abusing me.
It's sport sometimes. That's all.
Well, it's amazing.
And I take as well as I give. So
yeah, I just wonder if it's not a sign of our advancing experience that we go away for 1 week and then we can't forget which buttons to push. And we're also joined here. I think Kim is able to join us for a few minutes, if not for the whole session here this afternoon.
Yep, I'm here. I've had my chocolate.
What is it, 50 degrees, and you guys are like thinking it's an ice box down there?
No, this morning it was 60 when we woke up.
Oh, that's terrible.
I know, but when you're used to 80s, your blood gets a little thin, so it's kind of like, woo. I was really kind of surprised. I got to wear a sweatshirt. That for about 2 hours.
Oh, that's bold.
On Sunday, Kim, Natalie, and I went out for breakfast, and we got in the car and pulled out of the garage, and the car thermometer said 12, and I said, this isn't so bad. And we got about 40 feet up in the road, and the car thermometer refigured itself at -2. So
that's when it begins to hurt.
Yeah.
Well, my mom would always tell the story of, back where she's from, you have to plug your engine block into the outlet so your engine block doesn't freeze up because it gets 40 below.
Yep, I've done that.
Oh.
Up in the Great Northland. Well, anyhow, those of you who are now wondering if you have tuned into the Weather Channel,
the Home Companion Channel, Mark. Okay.
Cold companionship. All right, so let's go ahead and get underway. This is our first session of the new year. We are going to talk a little bit about performance, a little bit about the Epiphany stuff. That is a picture of Ken and me in the middle down there from a past national convention. That one happened to be in Chicago. I missed that laptop. I died shortly after that session, but we are going to talk about a little bit the year behind us and the year coming forward, get out one of Ken's favorite charts, and talk about camels a little bit, and because we can't get away from one of these sessions without, a various and sundry assortment of animals. But let's go ahead and get underway, guys. All right, here's your reminder, standard boilerplate stuff. For those of you that are new here, we try to keep it fairly informal, but you should always, always, always remember that no investment recommendation is intended. This is all about education, and the word demonstration is important. What are we demonstrating? We're basically attempting to demonstrate the lessons learned, basically a legacy which now stretches over 8 decades with the modern investment club movement. What are the philosophies? What are the methods and techniques? How do we find stocks? How do we build portfolios? And how do we take care of all that stuff? That's what we're demonstrating. We use real companies and real-time analysis to do that. But you still have to do your own homework, audit, trust but verify, and make your own decisions. If we hold securities in our portfolios, or if we know people who do, we will disclose that. Try to remember to do that. This session, I promise you, will be shorter than usual because we do have our monthly roundtable. It's the December roundtable tonight. That's just a gathering of friends sharing ideas that now goes all the way back to 12 years ago. The rate of return on the suggestions made during those sessions over 12 years is 19% annualized. If you'd like to be added to a reminder list, we do it, again, once a month. It's generally 8:30 p.m. Eastern Time on the first Tuesday?
Last Tuesday.
Last Tuesday. See, you go away for a week, you forget this stuff. The last Tuesday of most calendar months, we moved ours from Christmas to now, just to give us a little bit of breathing room from Christmas. So send an email to nkabula1@comcast.net, and you'll get email reminders about future sessions. I think we'll keep doing them as long as people enjoy them and as long as we have fun doing it. If you have any questions, comments, suggestions for future topics, or you want copies of slides, etc., My email address, markr@manifestinvesting.com, and Ken's, kcavula1@comcast.net, are both there for you. All right. Well, Ken, I still haven't read the inflation stuff yet, even though I spent a week on the beach.
Now, why would you read that while on the beach and enjoying family? Come on.
Couldn't bring myself. You'll see later what I was watching while I was on the beach. And don't let your minds run in the wrong direction there. Keep it clean. This is a PG-13 broadcast. But we will talk a little bit about some performance and some stock ideas. I think we will continue our long-term perspectives sessions with companies like Salesforce and Paychex. And we've done some of those others. You can go back and look at previous sessions on those first 5 or 6 there. And then our traditional update on the Groundhog, which we are at T-1 month on the Groundhog. So it's getting real now. Crunch time. And quick update on the best small companies. And we will cover those other topics, including that inflation topic, probably after the inflation concerns subside and it's no longer newsworthy. But any comments or questions or things you want to throw on the fire there, Ken?
Well, I just see that you were able to get the Groundhog portfolios back tidied up again after that strange happening with that one company. I don't quite understand what happened to its ticker, but its ticker seems to have disappeared. It went to a new ticker and a new name, but it's the old company. So
yeah, they switched their ticker like on the last day of the year, and it switched to a
the 28th or 29th of December, right?
I don't remember, Core Card or something like that. And it was in 9 or 10 of the Groundhog portfolios, I think.
Yeah, and it really pushed every one of them up to the top of the list there for a couple of days.
If you were really watching as I made the corrections to that, I mean, I had people doing dances and sending me screenshots, and when you have a $40 stock that is suddenly $890, it makes a difference in your portfolio. And people were celebrating, and I actually have letters from some of the contestants to others saying, "Enjoy your 15 minutes of fame. You're coming back down." I think Len even posted some of that, just telling everybody to calm down.
I watched one portfolio just in that one stock gain over $8 million. So
nice.
Yeah.
Without Bitcoin.
Without Bitcoin, right.
Very cool. All right. So we will tackle some of those other topics in future sessions, and we will be adding to that inventory. And we'll stick with some of our traditional stuff until we're tired of them also. But here, I thought we'd just start with an end of year situation with the market long-term return forecast. We publish this every week at Manifest Investing. What you're looking at here is basically a time series. That's just a fancy way of saying these are a bunch of quarterly snapshots going back now 22, almost 23 years, I guess. The green bars happen to be the value line arithmetic average. We're going to talk a little bit more about that in a minute. But they basically represent the general stock market. It's one of the measures that we use for looking at the general stock market. It consists of the 1,700 companies in the standard edition. So you're looking at kind of an average price, if you want to think of it that way, or an index of those prices that are that represent those 1,700 companies. So you see the hole in the chart back in 2008 when that nasty time visited us back in here. And that's when our return forecasts went up here. And basically all stocks were in the buy zone for a while, if you could grit your teeth and believe it. But from left to right, you basically see the progression. The blue is just simply a mathematical regression or a trend line provided by Microsoft and Excel, just to remind us that is kind of the exponential growth curve that we're on for the vast majority of these companies. The red basically represents the collective result, as if you had done think of it as a stock selection guide, those of you that speak that language, or a stock study return forecast, and the average or median stock study return forecast for all 1,700 companies. And again, we had one of those moments just a little over, we're coming up on 2 years now, where everything dropped off when COVID hit, and return forecasts actually soared to those levels last seen in 2008 and 2009. And actually, the price turbulence back in that time frame is probably the most dramatic in history, the downside and the upside, and much more short-lived than the 2008, 2009. Anything jump off the page at you, Ken, here? How do you feel about the general stock market right now being at 7.8% right here?
Well, it's where I think it probably should be, Mark. I've always in the last 3 or 4 years, minus that kind of blip when COVID came in, and it didn't seem like a blip then, I know, but it certainly has turned out to be something that it was kind of momentarily for most stocks coming and going. But I know the average is around 10, and I've always felt the market's been a little bit overvalued now for the last year, 2, maybe even 3 years. And these dots kind of bear me out there. There's an awful lot of them below the 10 that goes across that page. That's the average, the long-term historic average, and I still think it's probably a pretty decent number to use as a look back on the whole stock market.
Yeah, and I did want to point out that we are at 99.94, so I think we should buy some hats. VLE 10,000 hats, and maybe we'll wear them at next week's session if we make it. We're probably there today. So it's an opportunity for mild costuming, Ken.
Well, now these bars, Mark, are they coming up monthly? Is that when they're coming up, or is this twice a month?
Those are quarterly bars.
Quarterly bars. Okay, so we don't quite have a quarterly bar ready to go yet, do we?
Oh, you want to see what it looks like on a monthly basis? There you go.
No, monthly. I kind of thought maybe it had popped already but it hadn't popped. Okay, I thought it had popped and come back.
A couple months ago, we briefly had that excursion up, and it didn't stay there very long.
Okay.
Are you telling me that you have a 10,000 value line hat from 3 months ago?
No, I'm just thinking that I had noted to myself that it had popped and it didn't stay. Much like the $3 trillion valuation in Apple popped over for 10 minutes and then popped the other way, came down beneath again. So these numbers are kind of meaningless, but they're certainly numbers that people remember and look back on as if to say that was the start or the end of something. I'm not quite sure sometimes what they're commemorating, but it's numbers that are always talked about.
Yep. All right. Well, maybe Kim has the 10,000 hats.
No, not me. It messes with my hair.
There you go. All right. So here's one of our favorite charts to give true long-term perspective. And Ken, I'll just let you.
I just love this chart. Yeah, I just really, really like this chart. This is nothing more than the performance of, and Mark, is this particular one measuring S&P? Is that what this one's doing?
Yeah, this is S&P 500, so 27% for the most recent year.
Yeah, it's doing nothing but measuring the yearly performance of the S&P year by year. There's no significance to the colors on the chart. They're just there to make it easier to spot some things that are going on. You can see what a good decade the 90s was. You can see what good decades all of this century have been, with the exception of a couple yellow ones, floating down to the left over there. But it just makes the point in my mind that if I follow my discipline and stay patient, that the odds are I'm going to make money in the stock market. The times of absolute abysmal returns are few and far between. I know how much they hurt because I've lived through them, but at the same time, they leave pretty quickly. I mean, 2008 turns into 2009, 2008 way over to the left, but 2009 in the 20 to 30% return category, 2010 in the 10 to 20% return category. So, if you're just patient, you're going to make money. And when you redo this chart, and instead of doing 1-year returns, do 3-year returns or 5-year returns, you'll be amazed that there's virtually nothing sitting in any of the negative columns when you finish the arithmetic. And it's nothing more than arithmetic. It's not simple arithmetic. It takes a little tiny bit of algebra, or a little tiny bit of figuring out growth rates over a 3 or a 5-year period. But, minus the fact you have to figure out a cube root or a fifth root, it's not really that bad with a calculator. But the graphs are stunning in their simplicity, and in the fact that there's virtually no 5-year period in the last century where you would lose money in the stock market. There's just virtually none. It's an extremely interesting exercise if you've ever tried it, and we even include some of these graphs in our beginners class to try to drive home the idea that a lot of the myths that get promulgated about the stock market, about it being nothing more than a proxy for a casino, they're just not based in any kind of fact. Capitalism works, and the system of making money over long periods of time with patience and discipline and looking for good companies at good prices will set you up for your retirement if you only stick to some kind of discipline.
Yeah,
that's enough. That's enough of that. Go on, Mark.
yeah, to me, it's definitely taking on a bell curve type shape.
Yep.
For those of you that have only been doing this for a little while, 2018 was a rough year, but we like to point out that, well, here's 19 right over there. So those two obviously offset each other pretty well. The one period that I do remember that was a little more challenging, Ken, and you remember this too, is this 2000, 2001, 2002 period. And that really damaged a lot of investment clubs that we worked with. Some people just got just plain old fatigue after 3 years like that. And like Ken said, that has been so rare in history. That's not to say it can't happen again, but the price of that just breaks my heart some days, because, you come right out of that and you can find plenty of years after that right in here. And it basically bashed a few people out of it. One of the things that Ken and I do experience on a personal level is people who persisted and prevailed after that period, or perhaps started after that period. They're impressive. I mean, we're looking at some really impressive performance characteristics of some of the model clubs that were formed back in that time frame. So if you hang in there and grab that fat part of the bell curve, and knowing that in any 1 year you can drift a bit, it's pretty neat stuff. All right, so here's that value line again. And one of the reasons I wanted to point this out is, again, going back to some of my earlier days as an investor, and with an investment club started back in 92 or 93 back in Chicago. For me, as Ken has pointed out, since 1990, back in that time frame when I first became involved with the modern investment club movement, the S&P 500, even with these really, really strong years here lately, it has now gained 10.6% a year. And over that same time frame, this value line arithmetic average that we mentioned earlier, basically the average of those 1,700 companies that are in the standard edition, that's what's shown in this bell curve. And similar situation, I do want you to notice that this 2009 is actually farther out to the right than you saw on that previous page. Like, where is 2000? In 2009, for the general stock market, actually fell here into the 20 to 30. But if you looked at the value line arithmetic average, that was actually up more than the stock market's ever been. So that was really a great year, coming out of the heels of the that recessionary period, which I refuse to call the Great Recession. But what this says to me, again, bell-shaped curve. a little bit flatter, but some of that is really robust to the right. And what it represents for me is this notion of buying small, faster growing, medium, and larger companies, a nice blend. We refer to it as all of the above, basically being willing to discover and pursue and objectively study all of the companies that are in the Value Line Standard Edition. So, like it says there, try and talk us out of that, looking at those two charts.
Well, and what's especially impressive about these bell shapes, Mark, is that they don't follow what a knee-jerk might expect them to follow. I know that a lot of people that don't look at these graphs real carefully and that don't think about them very much would assume that the height of the bell curve, the most prevalent value, would be around 0 somewhere, and it's just not. It's somewhere between, on this curve, somewhere between 10 and 20%. And that's a great place to begin the most prevalent return.
Yeah, it's right. It's basically down the middle, maybe even leaning a little bit to the right. And it's shown here mathematically, 14.5 versus 10.6. It's basically suggesting to you that if you're willing to invest in small, medium, and large companies, you can gain as much as a 4 percentage point advantage to the general stock market. It's a really simple formula. And in times like we're in right now, it's such a powerful thing to be able to say, you know what? I think I'll go out there and try to discover excellent companies and look for some that might happen to be on sale. Rinse and repeat. Kim, did you have any thoughts on this?
Oh, I know you guys say that, but I swear that the good Lord tells me that every time I touch a small cap, I have bad luck. So I've got to obviously improve my stock picking in that area.
Well,
yeah, I'm catching the comments, Mark, that would like you to add the word annually after both of the bullets on the top of the slide, and received, folks, received. We understand. Mark said annually, but the slide doesn't say annually, so we'll make sure that says that.
Okay. All right. Well, here's my public service announcement for the day. I have made my New Year's resolution for the year. Those of you that follow me on Facebook know that it is to do what I want this year.
And how is that different?
Well, I actually added the sub resolution as long as Wendy says okay.
Smart man.
But we point this out basically every year at Manifest Investing that January 4th, behind Easter, Christmas, and Valentine's Day, is the day that people generally give up and eat chocolate. Kim was munching on some chocolate just a few minutes ago. She's guilty. So if you want to win this game, you wait until after everybody's done. Believe it or not, those crowded gymnasiums and health clubs they actually go away every year too and return to normal. But it is kind of amazing that annual Gravity Day is only 4 days into the new year. So one of the biggest challenges when it comes to investing is to maintain discipline, and I think that's what probably the most powerful attribute of the modern investment club movement for me, Ken, is that it really does provide a reminder about discipline and a notion of investing regularly. And I wish I could say I was as disciplined as I want to be, but there you go.
Well, what I like about a club situation, Mark, is that it asks me to do certain things that aren't onerous. It doesn't ask me to spend 30 hours a month putting together detailed reports on a large number of stocks. It asks me to listen, to follow 1 or 2 stocks, and to be an active participant in the discussion of what we should do next as a group. And if the group all takes an hour each month to put their little tiny piece together, then you have a high functioning club, and you make good money, and everybody's happy. So I don't see any downside. And being from an older generation, another benefit, for as far as I'm concerned, is the social aspect of getting to know some people really well, learning how they their mind works a little bit, learning how to trust them and learning to be trusted, and to end up with not only a nice nest egg and a lot of knowledge, but to end up with some really dear friends as well.
Absolutely. Without question. All right, and speaking of small companies, as Kim just did, this graph is beginning to look a whole lot more nice to me. And we're actually getting a little bit of spread in it too, from top to bottom. Notice that the traditional, which is our traditional Halloween to Halloween performance. So since Halloween, our traditional 20 stocks without any management whatsoever, it's the passive version of this, has actually picked up $70 on 2000. And the active, which we are experimenting with, is basically we are willing to sell and replace any company that makes certain triggers, like our relative return trigger, or perhaps on the top side, if the projected return drops far enough that we can find a suitable replacement candidate. The only transaction we have so far is eHealth that was replaced by Pachira Biosciences, and that has been the fuel for the engine to take that blue bar up to a little bit higher level. And notice that they are both beating the market. We hope that stays that way.
Mark, what I saw in the last 3 or 4 years of charts like this from our small company experiments is that it's starting to happen on this one. And I find that really heartening that if we look at the top stock, it's already taking fully care of the eHealth, even if we manage this with no active management at all, and it's beginning to bite into the loss from Irobot now. Last year, the gain from the top stock covered all the negatives on the entire group.
Mm-hmm.
So we're already starting to see that happening. And if we look carefully, we certainly are seeing the top 3 begin to snuggle up and swallow up the bottom. And if we're looking at rules of 5, 1, 2, 3, 4 going up certainly has a break point. If I were grading this list, I'd certainly be putting a slash between the -3.2 and the -11.9, because that's a difference in grade. That's a C to a D or a D to an F, or however you want to look at it. And there's your rule of 5, 1, 2, 3, 4. That's how many should not do as we expected. And there they are, Sharps, Superior, Irobot, and eHealth right now.
Mm-hmm. And eHealth continues to struggle mightily, so that's why the red bar is lower than the blue. We did talk in a fair amount of detail about Irobot. We have a mini update here, but again, the ones at the bottom, the question you ask yourself is, are they temporarily just simply bargains, or is there something actually wrong? And that's the question that you have to ask. And of course, we also want to take advantage of anything that gets tremendously overpriced, like, Pat Donnelly picking Stone Company and having it go from $10 to $60 in a couple months. Sometimes you have to take advantage of that situation too. So,
and since this is a relatively new chart, we still should point out that the horizontal lines on the graph in the upper right are still only $5 apart. So there's not a whole lot of spread between these 3 numbers, but they are certainly moving in the right direction right now.
Mm-hmm. Here's a quick update on Irobot. We did look at it 2 weeks ago. If you want to go back and get a little bit more comprehensive update, Value Line did come out with a Christmas Eve company report, dropping the sales growth forecast a little bit. And the one concerning item that I have, by the way, we just got one of these to run around in our house. It's kind of like watching the Energizer Bunny. It's kind of fun. The one thing that has happened in the last month or so is that they now expect, they being the analysts, including Value Line, expect the supply stuff to persist for quite some time. And Ken, you and I probably should have a discussion. Is that the type of company we want to have in a 1-year portfolio? If those expectations, you can see up here with the operating income line being expected to be kind of in the dumps for a while, it's probably a discussion to have. But, again, stepping back and not thinking about the price situation, relative to where we bought it, the company still looks decent. If recovery can truly be expected. The other thing that kind of bothers me is a friend of mine just said this week, there's thousands of companies out there. You don't have to settle for one that's got a black line that looks like that. So, he was kind of cutting to the heart of the matter there. You can find them where they're trending in the other direction, and maybe you sleep better at night. I don't know. In general, though,
he's talking, the black line he's referring to is the margins line, Mark. Is that what you're?
Right. Yeah, they're just
okay.
The trend that it's been drifting down. It's obviously been knocked
right.
down by the pandemic and the supply chain issues. But again, you're kind of hoping that that's going to be restored to that 11% level that you see out here. And that is nothing more than hope, perhaps informed expectation. Certainly not unreasonable. But again, in our context of a 1 year, small company portfolio, maybe we do have to think about that a little bit.
Well, and Mark, if we were going to bring supply chain concerns into Irobot, we probably would want to take a real serious look at another, maybe even half of the companies on the list here as it relates to supply chain, because if those concerns are going to persist, then there are going to be winners and losers, and I'm not certain how I figure out which is which in the short term.
The only reason I bring it up is it was called out by the Value Line and some other analysts that are covering in this case. So that's there. There's the update. You can go back and compare it and see how much it's changed. Let's keep rolling. Here's our Groundhog update. We continue to be a little bit pummeled by the market. We are up to a 6% average total return. So that's beginning to be a little bit respectable, but keep in mind that the market's up 23% over that same time frame. Ruth Wilfong has taken over the lead. She's got a 3 percentage point lead there. Nick continues to lurk. One of Ken, your investment clubs in mid-Michigan has to be strutting like roosters, at least with your $5,000, well, it's a $6,000 lead over Space Coast, which is an interesting competition unfolding there. What are your thoughts?
Well, the competition is really between number 7 and number 10 because those people all know each other. So
that's when it gets really fun.
Yes.
I know that Barb Masters at number 6 knows Ruth pretty well, so they're in a bit of a contest there too. But a lot of familiar names on this list. Len Douglas, you heard us teasing him in the green room. He's been steadily heading back to the top of the list, and he's got a real shot at it too. I'm still not on the list. I will say that I am within $16 of Anna Gombar, not Rod, but Anna. And anytime you can be within $16 of a repeat champion, I'll take it. All right, so good stuff there. We'll obviously keep posted, but keep in mind that we are 1 month out, so it is time to start your shopping for Groundhog 16. And we'll come back to that. All right, just a quick reminder that we have been looking at these extended analyses of a longer look, a longer visual analysis, a longer business model analysis of companies like Under Armour, looking for those telltale phases of life cycle development for any company. Here was Under Armour. It is one of my favorites. Here was Microsoft. You can see certainly different phases in terms of the top line and the profitability as measured by earnings before interest, depreciation, taxes, and allowances. That's basically operating income. Same thing that we look at, similar to what we look at in the pre-tax income in Section 2A of a stock selection guide. So again, these are some of our favorite slides. We're not going to give up on them. They manifest in a worksheet that basically allows us to do this type of stuff, and we will be spending more time with these type of companies. Today, I thought we would close our session with just a couple comments. It is the Epiphany. I think it's tomorrow officially. Some people celebrate it on the 5th, some people on the 6th. but I thought I would unveil our secret successful screening criteria underneath the gold, frankincense, and myrrh, whatever frankincense and myrrh are. But I think I understand gold. And it really comes back to what we were talking about a few minutes ago. I know you guys get tired of hearing it. We don't get tired of talking about it. No matter what the market conditions are, anywhere on that sheet that we were looking at a few minutes ago, sometimes the market gets red hot. Sometimes it's actually cold. Opportunities move around from small companies to large companies, and there's a sector rotation, all that kind of stuff. But if you're always out there looking for excellent companies as part one of your screening criteria, and as part two, asking the question, are they on sale? That translates into, do they have a promising return forecast, and is it credible and viable? That never needs to change. That's something that you can do continuously. I was on the phone with an investment club this morning that bought a company similar to what Ken's going to talk about tonight, and they're looking at some of the same type of stuff. So that's really what it does come down to. So what I thought I would share is a quick look at where I'm shopping for tonight's roundtable. This is a stock screen at Manifest Investing. Most of you are very familiar with this. I simply said, first of all, I want excellent quality companies. In fact, I want the top 10%, not the top quintile. So I didn't stop at 80. I set my minimum at 90 for quality. And then because, the return on the overall stock market is down in the 7.8% range for the return forecast, it's going to be a little bit more careful, a little more demanding. So I want high financial strength. You'll hear Cy Lynch talk about this all the time. By the way, Cy Lynch is absolutely blowing the doors off the roundtable performance over the last year. We're going to have some real fun in February when we do our awards program. Hope you're looking forward to that, Ken.
I certainly am, Mark.
And I limited the earnings per share stability to 80 also. And then I wanted companies that are, 5 to maybe 7% greater than this. So you can see that the settings that I chose here. And it's actually a fairly interesting list. And I will tell you, I'm going to rake this integrated freight and logistics company out of the Netherlands over the coals because they do look kind of interesting. I don't believe this number is credible. That's an analyst consensus estimate, but probably won't end up there when I do my own study. But if anybody,
Mark, when you talked before the session about the company, I didn't realize which company you were looking at. This one is very difficult to find in the databases, and you might start by asking your broker whether or not you can actually buy it over any exchange here in the U.S.
good tip. I will look into that.
Okay, we had I'm trying to remember the name of the Canadian company with a French name, and it wasn't the Circle K company. It was a
not Enghouse.
Enghouse, yes. It's not French, is it? Enghouse is the name of the company that you couldn't, in fact, buy over our exchanges in any straightforward way. It happened to be pink sheets, and you had to go through a whole different process to get at it. So this one won't even come up in some of my databases, for example.
Right. Yeah, and I do know it's listed as a DSD version of a ticker in some places. But we'll take a look at that, and that's obviously part of the consideration. It's got to be pretty special. It's got to pass a lot of tests to qualify. Maximus is probably my fallback. That is I believe it's a 7-time selection for the roundtable, so it's a repeat. But there is some new news there. You want to steal some of my thunder for tonight, Ken?
There's two pieces of new news in the last year. Maximus has gotten 2 large contracts, and the only reason I know about them is that, number one, I own the stock, and number two, it was my second in line for tonight as well. They just inked a really big contract with the federal government to redo the SEC's Edgar system. They're going to completely reorganize it and make it friendly to the users of the site. At least that's their their on paper goal. And then the other contract they signed was also with the federal government. They're going to take control administratively of a large portfolio of student loans and reorganize it, make it more friendly to the person that's taking out the loan, easier to deal with, and try to turn that experience into something that a normal person can make heads or tails of. It's important to realize that Maximus is not doing any of the programming. It's doing the administration of the program. So they wouldn't get into setting rules for the loans. They wouldn't get into dealing with who gets the loans and who doesn't get the loans and how they're paid back. They would just be administering the rules that are set by the agency that has overall control of the program itself. So I've owned Maximus for years in some of my clubs and personally, and it's never been one of these blow it out of the park kind of home run hits. But over the years, Maximus has given me about a 14% annualized return. And that's exactly the kind of return that I expect to get out of my mid-sized companies. They do all the heavy lifting in my portfolios. And if I can get, 13, 14, 15, 16% out of those mid-sized companies, then they're doing their job. And Maximus has certainly lived up to the doing its job part of being in my portfolio.
Yeah, and if I don't go with Maximus for whatever reason, Boston Beer has had a pretty good run, but it's still, I think it's still fairly attractive. And I did do some field testing this past week. So, I'm up
We
to date.
always have to do field testing because for us women, it might be shopping.
Well, I actually saw it truly being consumed by people, which is their seltzer stuff. Maybe there's hope that drought is over. And Ken, I know, and Kim, you also, I know that the regional bank showing up on here probably causes both of you to go shopping. Maybe we check in with Ross and make sure there aren't some great smaller banking ideas out there too, because I don't think that run is completely over yet either.
Yeah, Mark, I'm interested in the fact that in a space of 3 days over the holidays, I got recommendations on the same company twice from people that were completely unrelated to me and that I didn't even know, and they had good reasons both times, and the company was Borg-Warner. I'm fascinated to see it appearing on a list like this. Maybe I need to put it on my list and do a little bit more diving into what it has to offer.
Could be a good assignment for Matt and Len too.
Yep.
Yeah, I play tennis with some honchos from Borg-Warner. Maybe I could get some insider scoop that we can share in our private forum. No, I'm kidding out there, especially if you're from the SEC and you're listening. Lori, we know better.
You could have a meeting with Martha, okay?
All right. And last but not least on that list, it's a company that I've been interested in for a long time and have never pulled the trigger on it. It was one of our best small companies years ago, Texas Roadhouse, which every once in a while it comes back and emerges on a screen like this. So who knows? All right. So that's where
you wouldn't have any supply chain issues with Texas Roadhouse because all the cows are here in the U.S.
Yeah. So we can duck the supply chain. I'll bet you they sell Boston beer too. Probably got some Boston beer available. All right. So with that, just a reminder that on YouTube, we do, under a Manifest Investing channel, archive all of these sessions. We archive the roundtables, the bull sessions, which is this session is weekly. The roundtables are monthly, and then we have another monthly program that just basically does snapshots of a bunch of column type materials. Our successful investing conferences are also here. You can see 4 examples of that from our fairly recent successful investing conference. So go there, subscribe if you like what you see, and you will be notified anytime new content is added, and we would appreciate that. Here's our reminder that we're meeting again tonight, so we're going to cut the session off a little bit short. Now, I still have a stock to discover. Ken's is in. Kim is close. Did you finalize your selection yet, Kim?
The one we discussed earlier, yes. I still need to finalize the PowerPoint, though.
Okay. And I'm not sure about Hugh and Cy, unless, have you heard from either of them, Ken?
No, from neither one, Mark.
Okay, I'll check in and see how they're doing. And with that, I'll leave you with what I was watching when I was on the beach. Those of you that thought I was talking about something else, that was available, but this is our grandson observing, he's 2 years old, observing the Gulf of Mexico. And this was an attempt to get his toes wet. And I think if you look at that a little bit more closely, you can see that Grandpa and this is Logan, known as Logie Bear. He got a little bit more than his toes wet.
He just has some anatomical definition problems. That's all, Mark. Okay.
Oh, and he will tell you about it too. So that is what I spent the time relaxing. Maybe we'll get some pictures from Richmond or something to share with you in a future session. Either that or Kim always has some pretty good vistas.
Maybe I should send you some more.
They're always welcome. And in fact, they're welcome from anybody out there. We have featured slides from a number of people. And perhaps as we get closer to the end of the Groundhog, we'll have some that are related to that also. All right.
Michael is asking, where on the Panhandle is this, Mark, or where in Florida is this?
This is actually at Indian Rocks Beach, which is near Tampa, just south of Clearwater. It's a beautiful beach. Our daughter and her family are just enamored with it. So good stuff. All right. Any closing thoughts, Kim?
No, nothing from me. Just everybody have a good day and go stock up on chocolate.
Hey, well, we'll talk to everybody this evening then, Mark.
All right. Thanks, guys.
Good night.